And a very good evening to our valued clients, partners, distributors. Thank you for joining us and spending the next hour or so to listen in on our views and thoughts on markets and the disruptive innovation space. I'm Aimee, and I'll be your host and MC for this evening. There's no denying the future is here. With technology evolving at a rapid pace, we are seeing disruption happening all around us across different industries, whether it's the physical world, virtual, or even the metaverse. The next frontier of innovation is upon us, and no other investor believes this more strongly than our guest today. Spurred on by the spirit of human ingenuity as well as its capacity to innovate, she believes that we are just on the cusp of a bold new era of technological progress. We're honored today to be joined by famed futurist and prominent investor Cathie Wood, the CEO of Ark Invest, who will share her unique investment philosophy and deep insights into global markets for the first time to audiences in Malaysia. Together, we'll help unpack the outlook for 2022 and what's next for tech and tech investors. Markets had indeed been on a high-octane roller coaster ride. And as an investor myself, it was rather painful to see my returns being wiped out. Should we give up now? Should we average in? Should we sell out totally from the markets and hold on to cash? What should we do in times like these when there's just so much uncertainty? As the saying goes, I will tell you how to become rich. Close the doors. Be fearful when others are greedy, and be greedy when others are fearful. This was famously quoted of Warren Buffett. You are not alone in this investment journey. And as our investment managers are here holding the fort to ensure we continue to uphold our duty as fund managers to invest prudently over the medium to long term. We are responsible for the trust that has been given to us, and never will we take this lightly. We hope this evening, by the end of this hour, you'll feel enriched with greater knowledge and insights to help you weather through any volatility that will come your way throughout your investment journey. We have received more than 100 questions, and we'll do our level best to get them addressed this evening. But before I hand over the floor to Cathie, I would like to bring on our partner from Nikko Asset Management, whom we have worked with to make the disruptive innovation strategy available to investors in Malaysia. Darius Foo is the head of intermediary business development at Nikko Asset Management. Hi, Darius.
Hi, good evening, Aimee.
Yes. So before we call Cathie up at 7:30 p.m., some quick questions for you, Darius. With smart money exiting high growth stocks last year,
Yes.
have you seen significant redemptions from the disruptive innovation strategy? And what would you do if more redemptions starts to kick in?
So definitely as investors who are, having your money in this particular strategy, one of the worrying things, especially in the sliding market, is if other investors are redeeming their money, it might force the fund to inevitably have to sell at these favorable prices. So, definitely as fund managers, this is something that we were very concerned, we were watching out for and we were looking out for. But I think fortunately for us, and thanks to the support from, Affin, Hwang and all the relative distributors that are on this call, as well as the end investors who are on Facebook and YouTube watching this stream tonight, because of all your support, I believe that many of you invested with the same conviction that Aimee talked about earlier on in disruptive innovation. So truth be told, in 2021, even as stocks and shares prices were doing a double down, so to speak, right? And what I mean by double down is in dropping and dropping further. There was not a lot of redemptions from our fund level, to be very, very honest. And I think the few concerns, right, that was out in the newspapers or in the news was about, how there were investors in maybe the US and the international scenes that was drawing out monies from the disruptive innovation strategy. And when we spoke to the Ark team about that, realistically speaking, they were sharing with us that those were the very early investors who went in as early as 2015, 2016, and a lot of them, they have already more than doubled, tripled, or even quadrupled some of their monies. So it represents a significant exposure within their overall baskets of investments. And so that's why they had to, in light of the recent turmoil, taken a more prudent strategy to downplay that exposure. And so it wasn't because they've lost faith. Many of them, in fact, are still invested. They were just bringing their, overall portfolio down to a more realistic kind of a level. So what this also means is because nobody panicked, nobody pushed the button and redeemed aggressively, across the months of 2021, even coming to 2022, the fund continued to have a lot of, firepower, so to speak, so that even as prices were dropping, the fund managers were able to deploy these cash into stocks and shares that they had very, very high conviction in. And by now, many of us are familiar with the names in the portfolio, things like Tesla, things like Coinbase and all that, had incrementally, been topped up into when the timing was bad. And so as a result, we're really confident that when things start to reverse and things start to improve, our portfolio will be in a better shape because we had all this support going into this very, very difficult and tough periods. Yeah.
Yes, thanks, Darius. There are a lot of believers in this strategy, I'm sure. Yes, I'm one of them. Yeah. Second question for you. How would you advise investors who like innovation and technology, but they just cannot stomach that, the short-term volatility they're seeing right now?
Well, I think let's be honest and take a step back as well. I think tech and all these growth stocks, so to speak, has always been a portion of different people's portfolios at some point of time. I mean, maybe not so obvious as this period of time where there's really a lot of hype about tech. But if we go back 5 years, 10 years, back then the so-called growth stock, right, will be things like emerging markets, for example. And at one point, it will be Asia-Pac, ex-Japan markets. At one point in time, it will be EM debt. So I believe that there's always a portion of everyone's portfolios that is this so-called growth engine, right? So while we have some portion of it that's nicely sitting there making the stable returns, the 3, 5, 7, kind of a boring percentage, there are some of those things that's in everybody's portfolio that's a little bit more high geared. And these are the things that cause us to lose sleep a little bit in the night. And, once upon a time when all those things happen, it even causes us to question our own ability and our own understanding of whether we know what we're doing or not. And so this period, I would say, is no different from history. However, I would say that the magnitude during this period surprised us as well. Now, of course, there will be a lot of very seasoned investors out there to say, hey, this time around is no different. I've seen markets in the past swing up 100%, drop 100% as well. But I think what is very new is that, over the course of so many years, it's always been more, country specifics or region specific. There's very hardly a time where you see, tech per se, other than the dot-com bubble, right? Which I'm sure everyone's going to draw some comparisons to in a short while. But other than that, you don't really see such a run-up, and never has there been such a point in time, right, where there are so many tech companies that one can invest in. I mean, you only need to look back 5, 7 years ago when the MSCI World top 10 holdings, right, probably only had 2 tech stocks. And back then, what was it? It was IBM and Microsoft, right? So you don't really feel that, oh, I'm very heavily invested into tech. But today, anyone who's invested in, broadly any ETF or benchmarks, you know that your top few holdings, Google, Amazon, and if you open yourself up to Chinese markets, it's Tencent, Alibaba, so on and so forth. So I would say that, obviously because of this experience, the so-called momentum and the run-up has become even more exhilarating. And therefore, I think your picture earlier on about the roller coaster ride is very, very apt. In the same collapse of it, right, it has become even more frightening of sorts. So I would say that, if clients who are still in that belief, I would say, let's split up the conversational point to ask yourself, if you're in a believing state of where disruptive innovation should be, I think the key question is to ask yourself, how much can you, afford to lose? And I think that's the real question, right? When we talk about investing, there's no such thing as a sure win, you're Malaysian, I'm Singaporean, we eat durians, got bao jia, right? But when we come to investing, there's no such thing as bao jia. So I want to say that, for people like, who are maybe younger, or you have a much longer investment horizon, and I'm talking about 5, 10, 20 years, then yes, perhaps that percentage can go up a little bit. And maybe I shouldn't have used the word younger, because there should be some mature audience in, amongst us, maybe you're in your 50s and 60s, but you're really using this product for legacy planning as well. And you are planning for your grandchildren, which also means your time horizon is now 10 years again or 20 years, right? So we shouldn't be overly concerned at this point in time where things start to wobble and all that. But yes, if we're having a much longer time horizon and we can say, okay, I'm comfortable if I really lose and zeroize this 10%, then you can put a little bit more. But of course, if you're a bit more conservative, you need that money, then I would say that the right sizing of your exposure to a disruptive innovation strategy would be a conversation that you really need to have with your relationship manager who invited you to this call, or your financial advisor, so on and so forth. But Aimee, you earlier talked about how you're invested. I think even later on, Cathie should share she's invested. Many of us, even at Nicole EM, were also invested. And I would like to just use myself maybe as an example where I have very young children, and I don't see myself having a lot of short-term, financial planning goals that I need to attain. So personally, even all my money, 100% of it is in equities, right? So I don't own fixed income at this point in time. Maybe I will in 5, 10, 20 years time when my investment horizon gets shorter. But at this point in time, I'm highly leveraged or geared towards equity, which makes me a very risky investor, I know. But back to the same point that I said, I think I can take that risk, so on and so forth. Yep. So lastly, because you mentioned, is this a good time? Because if you believe in it, should we be investing in, disruptive innovation as well? And I wanted, or rather the question came in as, should we invest in tech, right? I think I wanted to, and you'll hear us talking about this with Cathie later on.
Yep. Thanks. Yeah. Thanks a lot, Darius. Yeah.
Yeah, it's about disruptive innovation. Yeah.
Yeah, thanks a lot, Darius, for that sharing. And now, ladies and gentlemen, we thank you for your patience. We have with us here now live virtually from Malaysia and also from New York City, the Cathie Wood, the CEO of Ark Invest. Hi, Cathie.
Hi, Cathie.
Hi. Hello. Greetings.
Hi. Yeah, it's so good to have you with us.
Oh, thank you. Oh, good. We've got the video right now, so we're ready to go.
Excellent.
Thank you so much. Yes.
Yeah, Malaysia says hi to you and good morning over there.
Good morning. Good evening. Thank you.
Yeah, I think our CEO sends his regards to you, and thank you so much for acceding to our request to have this event with you.
Oh, I'm thrilled. I'm really happy. I love Malaysia. It was such a delightful visit when I was there a couple of years ago, and I can't wait to go back again.
Yeah, thank you so much for spending the next hour with us. So much has been going on, and investors are all seeking answers, and we just want to hear your views and take on markets. I will now hand over the floor to Darius, who will help moderate, and because we had so many questions come in from investors. So take it on, Darius.
Right. Thank you so much, Aimee. So, thank you so much, Cathie. I mean, we speak quite often, yourself, my teams, and our teams within Nicole EM as well as Ark Invest. And yes, Aimee said, right, truly, when we posted out the surveys, we've got more than 100, 200 questions. And even right now, there are questions coming in from the Q&A box and all. So a big apology to many of the clients out there because some of the questions were similar. We had to cobble everything together so that we can make the full use of Cathie's time. So right now, I'm going to just jump in and, Cathie, this is going to be a bit of a dialogue. So I want to apologize in advance if I suddenly cut you off because I want to just interweave a point. Yeah, it is really to get the discussion going. So straight up, I'm going to talk a little bit of macro situation right now. Obviously, 2021 was challenging, but for a whole different set of reasons. We've talked about many of the factors about inflation. I think you can rehash a little bit about that. And then coming into, where we are right now with, 2022, a whole bunch of things has also happened, right? To fuel this entire worry about the growth stocks and all that. Now, I think you can share a little bit about your thoughts about some of these factors, but perhaps can you also skew it towards this particular question where they were asking about the similarities between, the drawdown now as well as the tech bubble many, many years ago?
Well, I will start with that, Darius. So thank you. Yes. We look back at I was there. I was in the markets at that time, and so I know very well what a bubble is and how it can end badly. What's very interesting today is I think the fears of a repeat of the dot-com bubble have many people worried about our strategy. But the facts are that in the late 90s, the technologies were not ready and the costs were too high. I often use DNA sequencing. It costs $2.7 billion to sequence the first whole human genome. Way too expensive, and the technologies weren't ready. And yet investors were falling all over each other to get a higher tech weighting. And that ended badly. Well, what is happening today? It's the opposite. Investors are so scared. They are running for the hills or running for their benchmarks, right? And if you look at the B of A fund manager survey, we haven't seen this low an exposure to technology since 2006. And we think that that answer is just as wrong as the answer in the late 90s. We think that there is so much disruptive innovation evolving now, the seeds of which were planted way back 20, 30 years ago, that there's a huge underestimation of how powerful these growth trends are going to be and how the technologies are going to converge with one another, one S-curve feeding another S-curve.
Mm-hmm. Thanks so much for that, Cathie. I think that's a very good analogy in terms of the behavior going one way and the other. I mean, obviously, back then as well, when you want to profile a tech or a disruptor, it's really, really different. I mean, back then it was probably, as I was saying earlier on to the audience, in the benchmark, you would have seen maybe Microsoft, IBM, and that was the tech play of the days, right? And this is obviously very, very different today. But before we go further into some of the stock names and all these others, another point about this whole worry and fear is the fact that, people, as you mentioned, were exiting the growth stocks and heading for value stocks. And I think in some of your videos as well, in some of your commentaries, you have mentioned how dangerous this is. Really, because at some point in time, these growth stocks are the ones that are going to disrupt some of all these value stocks as well, right? Can you comment a little bit more on that to give them a better understanding of where you're coming from?
Sure. The 5 innovation platforms around which we have centered our research and our investing, so DNA sequencing, adaptive robotics, energy storage, artificial intelligence, blockchain technology, they involve 14 different technologies, all of which are evolving at the same time. Mm-hmm. And they're going to be very disruptive to almost every sector. So, for example, the financial service, two of the sectors that have done best in this rotation to value, energy and financial services, we think are going to be disrupted in an enormous way. We think for financial services, the combination of DeFi, so decentralized finance with blockchain technology, and digital wallets is going to hollow out traditional financial firms. Yeah. We think that in the energy sector, electric transportation is going to cut the supply, the demand for oil in the years ahead. And what's also happening now with prices up so much, the supply shock, this is not a demand shock, this is a supply shock. And in fact, demand is below where it peaked in 2019. With these high prices, we think oil demand destruction is going to accelerate here. And I think people are going to be very surprised at how quickly oil demand comes down. Mm-hmm. So once we get the supply shock over with, we think that the big surprise is going to be lower oil prices. And then any industry or any company not harnessing artificial intelligence competitively, we think is going to be at risk.
Mm-hmm. Now, Cathie, I was going to go a little bit into what you were talking about oil and all that, but I wanted to maybe just park that question aside as well for now. Maybe in a very quick 2 or 3 minute spiel, because I sometimes still feel, in the course of speaking to clients and all that, that there's still a general, or rather it's a generalization when they're investing in our strategy that is all about tech, and tech meaning internet companies, so on and so forth. And I'm glad that you brought out the 5 innovation platforms and all that. Could you really also just share one more time to the clients, when we are looking at tech per se, what are we really talking about, from your perspective? Yeah.
Sure. Well, we're talking about innovation, which is going to cut across sectors. And so we have set up our research organization to specialize in technologies and generalize in sectors. Mm-hmm. And so we think the 5 platforms that I mentioned are going to be touching every sector, at least one or two of them, if not three. And one of the missing ingredients in most growth or technology portfolios is the genomic revolution, which is the convergence between and among genomic sequencing, so that's DNA, RNA, protein, so sequencing, artificial intelligence, and CRISPR, gene editing. The convergence of those three technologies, we believe, is going to be curing disease. So it's I think one of the most misunderstood of the innovation platforms, because many people don't believe it's possible to cure disease. But already in human trials, we are seeing cures to sickle cell disease, beta thalassemia, ATTR, and I think it's somewhere between 5 and 10 out of every 100 babies is born with a rare disease. Many, you won't know it for years and years and years, but many parents in those early years know that there's something wrong. Now we're going to be able to find out what that is, right, and potentially cure it with time as these therapies evolve.
Right. So, Cathie, thank you so much for that very clear explanation. But if I were to also just sum it up in a layman's term, because you talk about AI and all that. So what we are really trying to also tell the investors that AI is not just IT, for example, right? When you talk about AI, it's also going to impact consumers, it's going to impact healthcare, it's going to impact even industrial, so on and so forth. So we're not, in this strategy, we don't take some of all these things and bucket it the old and the usual way. Isn't that right?
That is true. And if you look at the S&P's technology sector, we don't own one of those names in our flagship strategy because it's all old technology. Mm-hmm. And if you look in the healthcare, the overlap with our names is minimal. Right. And again, it's because of our differentiated point of view on how technology is going to disrupt every sector.
Yeah. Thank you so much for that. So let's revisit that point earlier on when you talk about demand supply of oil. I say this because this is a very close subject matter to everyone's heart. I know you now drive a Tesla, an electric vehicle, but around the coffee shop talks, around, at least in Singapore, and I'm sure in Malaysia at some point now, is everyone talking about should we give up our, petrol-powered cars and start to make that switch? Should I sell my car and buy, an EV and all? But obviously, one of the key drivers about such a conversational topic is the current geopolitical tensions between Russia, Ukraine, so on and so forth. Maybe a quick word, especially because there's probably this misconception that, with labor shortage, chip shortages, energy shortage is already disrupting, disruptive innovation. All we needed was this invasion thing happening. So perhaps your thoughts on, the impact on this supply chain situation?
Well, yes, we believe that innovation solves problems. And we saw this happen during COVID. In the early days of COVID, before anyone understood what it really was, our strategy, the drawdown was very severe, but it was very quick. Yeah. And at the time we said, we don't understand this because innovation is going to be key to solving this problem. And of course, our genomic revolution strategy was the best performing strategy coming out of that. Well, here we are, we have even more problems now. And again, we think disruptive innovation is going to help solve these problems. The shift towards electric transportation, not just cars, but drones and ultimately even planes, we think are going to cut the demand for oil, just cut it for the first time in history. So we have been saying that oil demand, we believe, peaked in 2019, and it has not gone back to that level. These higher prices will kill it even more. And the number of people, as you say, thinking about buying an electric vehicle, now that it costs 2, 3, 4 times to fill up a tank, what it cost 2 or 3 years ago, the number of people has skyrocketed. And of course, the electric vehicles are also in short supply, right? So we think companies like Tesla and many of the other companies who are accelerating their shift to electric vehicles are going to be the biggest beneficiaries. And that's just one example.
Yeah. So Cathie, how about the rest? Because obviously there's this discussion about how, with the semiconductor chips and all that, that's now going to so-called slow down. Say, for example, we're talking about artificial intelligence, right? I mean, when we were forecasting it's going to grow, it's really because there was no shortages. Everything was fine and dandy in the world. But in your opinion, do you think given some of these other shortages could actually, be a drawback in terms of the progress that some of these technologies are going to be making?
Well, because our disruptive innovation models based on Wright's law depend on costs coming down, of course, that's why there's some interruption here, costs coming down and volume going up. So if we were to go into a recession, the volume wouldn't go up as much, but I believe that growth would be in very scarce supply, and we would be the source of growth. Right. And most of the value-oriented sectors that have done so well in here, and which benefit from inflation, they would be the strategies hurt. So when growth is scarce, our strategy tends to do very well.
Right. And Cathie, maybe I just dig a little bit deeper, because you obviously said costs may, go up in the short term. So again, just for clarity, we're not really talking about it becomes suddenly more expensive to do the research, etc. It's just all the other associated costs, maybe with transportation, like shipping right now. Anyone who buys anything from Alibaba or Taobao or Amazon, your shipping cost has gone up as well, right? And am I right to say what you're trying to point out to the audience today is that some of these increase in costs is just short term because of all these things, and when things normalize, we're going to see that back to the reversion of Wright's law and all that. Is that what you're saying?
Well, I don't think Wright's law has stopped at all here. No, I didn't mean to say that. I was just saying, because we're in an environment where there are shortages, there has been some slowdown in activity that no one can avoid, right? However, innovation solves problems. And if you look at what Tesla's doing around the chip shortage, they're doing workarounds. They're doing workarounds, and they can because they're vertically integrated. You'll find that those words we use a lot. Vertical integration. They have more control over their supply chain than others who are completely outsourced. Yes. So yes, I think innovation involves creativity and working around these supply issues so that Wright's law can resume on in terms of the cost declines.
Right. Thanks so much, Cathie. Now, another element, I would say, that probably helps to spur on innovation, helps to spur creativity, is the encouragement that you tend to get from regulators, right? And so I know you have repeatedly said, oh, well, US at the moment is favored because, the environment is very, very encouraging for such. And obviously, a lot of questions came in about the flip side, which, surprise, surprise, is China. So China has been doing all these, regulatory reforms, they call it, so in your opinion, will, these kind of regulations that's coming up from China and all that stifle the growth, the innovation that we're going to see? And also, is this going to be something that's going to be a knock-on effect to other parts of the world? What's your take on this as well?
Yes, I think China's addressing something that every economy is grappling with, and they're calling it common prosperity as their goal, so that the divide between the wealthy and the poor narrows. And I think they're doing it more through regulatory measures. And so the way we've addressed that in our various strategies is, well, in terms of the flagship strategy, we have pulled away because effectively what they're saying is any company with high margins is probably not contributing as much as it could to common prosperity. So high margins we're staying away from. So you'll see in some of our more specialized strategies, the low margin stocks like JD Logistics or Xpeng, which is modeling itself after Tesla in China, they have very low margins, and they're both addressing increasing access to tier 2, tier 3 cities, whether it's transportation or logistics. So I think that, China has always said it wants to be number one in innovation. I think that this is they've hit the pause button on that. Right. And that actually is giving other countries more running room to competitively to pull ahead. I do think China will get back to innovation. They just need to do this reset for internal political reasons. Yeah. And then we'll see how much they allow innovation to evolve again.
Right. So, and obviously we all know that, in the past you helped some China, you sold it off and all that. And given what you just said, it's obvious that you're still looking at the space. Is now a good time to start looking at opportunities there? Or, it's kind of more of we see opportunities, but we're weighing it against everything else where we can find opportunities. What's your take? I think a lot of people are wondering whether we'll start to see more China names within the portfolios itself. Yeah.
Yes. So as I mentioned before, in our more specialized strategies, we're dabbling, but there's no wholesale move into China because we need more signals from the government that the coast is clear, that they've reset the economy in the way they would like. We did get a glimmer of hope, I think, last week, where not only did they say they were going to ease at the margin from a monetary policy point of view, but I believe they said, we have to get this confirmed, and this audience may know better. I believe they said that they were going to start approving new games again. Mm-hmm. And remember, if the controversy, well, it started with Ant Financial, but very quickly it moved into gaming and the concerns around society's addiction to gaming. So the fact that they might start approving new games is a hopeful sign.
Right. Thanks, Cathie. Now, I'm just going to go a little bit deeper into this. I mean, just for the fun of it, I remember when you were in Singapore, maybe about 2 over years ago, and when we were talking about, opportunities into different markets and all, and I asked you this question, well, is there any hope for Singapore, the little small red dot, to have companies that will feature in your portfolio? And obviously at that point in time, it was very unlikely. But just because our audience tonight are mostly Malaysians as well, how about Malaysia? Do you see any opportunities, or are there things that you are perhaps looking at, which will, be an opportunity down the road as well?
Well, for those who, what we did as we were moving away from China is we wanted to maintain some exposure to Asia. So Sea Limited is a Singaporean stock, which covers shopping and gaming and fintech. So it's innovation all wrapped up in one company, and it's moving around the world with amazing speed. We've been so impressed with that management team. The stock, like everything else, has been hit. And so you saw we reintroduced it into our flagship strategy. And I believe everyone in Malaysia and Singapore knows Sea Limited, Garena and Shopee, so forth.
Right. Thank you so much. So it's good to know that even out here, we're not being overlooked. And I think I really wanted to just use this as a highlight to let people know that you and your team are really not just, viewing the world or disruptive innovation with a very specific set of lens, and you are a little bit more, in-depth, broad-based. So thank you so much, Cathie, for taking that fun question of mine. Lastly, just on the macro, right? I need you to now dig down, take out your crystal ball and all that, because the last question from, I think, a lot of the audience members is, are we in recession right now? Is this going to be a recessionary year? Or should we expect towards the end of the year or next year to really be a lot harder than, what we're even seeing today?
Well, we're looking at a few macro indicators to help us with that question. We know that the yield curve, so the difference between long-term interest rates and short-term interest rates, has been flattening. It started March a year ago at around, and I'm using 2-year to 10-year government bond yields here in the United States. It started at 1.6% or 160 basis points. And we're now down at roughly 20 basis points. And by some measures out there, we have inverted. So in our view, that means either growth is going to disappoint, which would benefit our strategy, as I mentioned, scarce growth, or inflation is going to surprise on the low side of expectations, or both. And we think it could be both. Now, in the United States, we see lots of strength in capital spending and housing. However, the consumer has weakened fairly significantly. If you look at the last 4 months, in real terms, pretty flat. And we think that we've been surprised at how tough the Fed has been sounding, because it too sees these indicators. So what we think is going on is that the Fed is looking at the current inflation rates and doesn't want the US economy, and whether it's business or consumers, to think that those inflation rates are going to stick. And so there's a lot of tough talk right now, but the indicators that we think are going to govern the Fed's activity in the future are suggesting to us maybe one more move, maybe not. Now, we thought they were going to do 50 basis points, and we were saying one and done. Maybe it's 50 basis points in two parts. They just did one, maybe there's another one. The market's expecting 6 or 7. We'd be surprised to see that many.
Okay, thanks, Cathie. It's good to hear that there's a bit of a divergent view coming from your team, because as you mentioned, yes, 6 is a very common number that's being thrown around quite a fair bit, even in this part of the world. Thanks so much. We covered a little bit about all the factors and all the things that have gone around the world that is out of your hands, because it's all about the macro and all these others. Perhaps we could just change the direction of conversation a little bit towards what is actually happening within the portfolio itself. And even if we take a quick look at the Q&A box right now, as well as a lot of the pre-questions that came in, obviously one question is that, the fund or the strategy specifically has already dropped, more than 40 to 50%. So depending on which entry point many of the clients have come into. So can we comment about some of the names first and foremost? Perhaps you can just shed light, like some of the stocks that dropped 30, 40% or 50%, did they really warrant that kind of a price drop? What's your take on some of the things that have been happening in the portfolio? Yeah.
And before I do that, I absolutely will get to that. Before I do that, I know you asked earlier about inflation. One thing I want to make sure that our viewers and clients understand is the disruptive innovation around which we have centered our research and investing is highly deflationary. And the deflationary pull is going to get bigger and bigger as these technologies scale, and it's going to impact the whole economy. What we're seeing right now in terms of inflation is a supply shock, and it's both food and energy, which is one of the reasons consumption has turned flat. The consumer's just trying to keep up with inflation, and is starting to recoil. So we think that the cyclical forces are also going to be down within the next 6 to 9 months. So I wanted to make that clear. And that worry probably is what has hit our strategy the most, because many people think interest rates will continue to go up. Well, the bond market is telling us that there's a different point of view out there, as I mentioned, with the yield curve. Okay, so in terms of the portfolio and how hard it's been hit, it is very interesting to see innovation being treated differently in the public equity markets compared to the private equity markets. If you look at the cohort of late VC funding that took place in February, and you look at the last funding round for those same companies, which was a median of 260 days ago, though the time between the last funding and the previous one, the appreciation has been 180%.
Right.
Whereas our strategy is down, as you said, 40, 50%, and some stocks more than that.
Yeah.
That is a big disconnect. And we think that the private markets have it more right. The private markets are seeing what we are seeing, which is truly disruptive innovation is valued in the public equity markets now at $10 trillion. So a little less than 10% of the global market cap out there. And we think it's going to $210 trillion in 8 years. That's a 20-fold increase, right?
Right.
So I think the private markets are onto this. The public markets will get it right. Truth wins out, we believe. And the way we will see this happen is as the economy slows down, our growth rates are going to continue at spectacular rates, especially on the top line. The bottom line will follow. So let's take some of the stocks. Zoom, everyone around the world learned, if they didn't know about Zoom before the COVID, they know about Zoom now. Zoom's user base went from 20 million to 200 million because of COVID. Now, most of those were free accounts. So their paid user base went from 15% down to 3%. Now that's moving up again. It's back to 11, 12. But think about COVID was a terrible thing, is a terrible thing. But it couldn't have done more to help the visibility of this company. And so we believe that they're going to keep much of that user base, and that the paid users are going to continue to move up to the 25 to 30% range, which means their margins will continue to grow. Now, their gross margins are already 70% plus, and they're going to continue to go up. So many people say, oh, you don't have profits in your companies. Well, Zoom is a profitable company. Yes. And in fact, it is being priced in the market at a less expensive valuation than many food stocks, including Hormel, which produces Spam. So there's a tweet out there saying, can you believe Zoom's enterprise value to EBITDA is cheaper than Spam? And we're seeing more and more of that. This misperception that we are invested only on unprofitable companies is just wrong. Right. The unprofitable companies tend to be in the genomic space. And as I mentioned before, we believe the companies in our portfolio are going to contribute to curing diseases, and they hold very valuable patents that will pay off over time.
Right, Cathie. I'm a bit guilty because I always quote you on this particular sentence about winner takes most, right? And when I say this sentence to the audience and the public out here, I actually do use Zoom because, one of the questions that we get is Zoom as a company is got all these other competitors. But, obviously you've brought out about the user base and all that, but I gave a much easier analogy. My 7-year-old son knows how to use Zoom without any trouble at all. And I think a lot of, companies and all that have gravitated towards using Zoom. So since you've already talked about Zoom and all that, and I wanted to really bring in this sentence about winner takes most, right? And becomes more popular, more dominant. Is there something that you can shed light onto as well with regards to some of these businesses that you're looking at?
Yes, winner takes most typically revolves around the idea that the companies collecting the biggest bodies of data, high quality data, and who have AI expertise and domain expertise. So think about genomics in this regard. You might have AI expertise, but if you're not partnered with people who understand the genome in a profound way, you're not going to be setting up the incentive, the reward systems in these AI engines correctly if you don't understand the biology. So the combination of the data, the best AI expertise, and the best domain expertise is going to create many winners take most. In the diagnostic space, molecular diagnostic testing, we think that company or one of those companies is Invitae. Another of those companies is Exact Sciences. And another one is Teladoc. Many people ask us, why do you own Teladoc as part of the genomic revolution? It is because Teladoc probably has collected more data on more individuals at an accelerated rate over the during the coronavirus, so telemedicine, than almost any other company out there. And so you have many companies who are going to disrupt the traditional diagnostic testing space, which has been commoditized. Those companies are not collecting data. They do not have the domain expertise and the AI expertise that Invitae, Exact Sciences, and Teladoc have.
Now, thanks so much. I think that becomes very, very clear as well. We're not talking about just, the user, the acceptance rates and all that, but behind the scene, what goes on in some of these companies that will eventually help them to become more dominant in the future, right? That's what we're actually saying. Cathie, can I come back to the point where you talked about, because obviously a lot of people think that with the disruptive innovation space, like you mentioned, we're investing in non-profitable companies and all that. So maybe perhaps I can rephrase it. I don't think that we're all investing into non-profitable companies, but admittedly, there'll be a few companies within our portfolio which has a higher cash burn than normal, right? Because they are out in that, the beginning phase and all these others. So could you share a little bit, maybe whether it's a historical example or maybe a current example within the portfolio where we are invested in companies which currently have a bit of a high cash burn, but why you think this is going to turn around and the situation will become, more profitable and all?
Well, I think Tesla is the most important case in point here. We for, I guess from the time we founded the firm, 2014 until 2019, Tesla was burning cash. And we were criticized for having such a large position in Tesla because it was losing money. And in fact, many people, I remember in early 2019, that bear raid was all about Tesla is going to run out of money and they're not going to be able to get cash. And I remember saying at the time, wait a minute, this is not 2008 or 2009 where the markets are just shutting down. This is 2019. The markets are open. If they do a deal here, we will be a buyer. So will the top holders, because they understand this is a winner take most story. And it's a winner take most in the autonomous taxi network space, which includes three platforms: robotics, autonomous vehicles or robots, energy storage, they will be electric, and artificial intelligence. Those are three major platforms converging. And Tesla has the domain expertise in terms of battery technology, artificial intelligence with Andrej Karpathy and Elon Musk, and the biggest amount of data in the world. And they did invest aggressively to get there, and they were losing money. Now they're more profitable than any other auto company out there. That's what happens when you bring together those three platforms and let one S-curve feed another. You'll end up, and when they go autonomous, we're going to see spectacular profitability, not just 27% for the electric vehicle margins, but for the autonomous platform, 80% plus. So we think that most people don't understand that side of these stories, which is, yes, the base business where there's a lot of hardware involved might seem like it's low profitability, but the ultimate business, autonomous anything, which will involve artificial intelligence, is going to involve very high margins. And the same thing will happen, as I just mentioned, to those molecular diagnostic testing companies.
Right. Is there any other, perhaps name or industry that you can share? Because obviously some of these molecular diagnosis stories and Tesla has been, the talk of the town, whether it's because in your videos or in some of the commentaries and all these others. Anything else that's perhaps not in the top 10 holding that you could shed a bit of light for our audience today?
Well, not in the top 10. We have a company like Roblox, which is a gaming engine, and it's driven by users.
Yes.
Gen Zers, think Gen Z meets metaverse. So, unprofitable now, but we look for platform companies that are going to be go viral. In this case, Roblox has gone viral. If you ask any Gen Zer, you'll
that was where we were talking about something that was not in the top 10 holdings. You were mentioning Roblox and all that. Obviously very funny for me because it's kind of like a kid's stuff, right? And maybe our more mature audience here may not be so familiar with it. Is there anything else you wanted to add on to your point about the Roblox before we move on? Yeah.
Yes, I'm not sure if you heard this, but in speaking with the CEO and the management team, we've learned that they are passionate about education and maybe the gamification of education.
Yes.
And we know, and I have an education foundation myself. We are looking at Roblox as we are moving into the middle school and helping with the science. So this could be a very big idea. It is already scaled way beyond, I think, many people's expectations. And the other thing is, more than 50% of its user base now is above the age of 13. There was a time there, and I think that might even be above the age of 18. There was a time people were worried that it would just be this group, the Gen Zers, and it wouldn't be able to grow with the Gen Zers as they were growing up. Well, it's doing a very good job of doing that.
Right. Thanks so much, Cathie. And I wasn't, in the know that you were going to bring up Roblox, but I think that's a very good segue for me to actually dive into one of the other sub-pointers that I was going to bring up maybe more towards the end, but I think this is a good juncture to interject this, and that is the metaverse, obviously. Since we're talking about Roblox, not just about gaming, going to education and all, do you have some thoughts around this? And perhaps also to share with our audience, is this the potential next thing that we're looking at perhaps coming into this portfolio to form yet another, disruptive technology per se? Yeah.
Yes, well, the metaverse to us is the next generation internet. So, but I'll back up and say what we think it's a part of. So this is a part of the blockchain technology movement, and we think, and we believe it's a revolution in three ways: a money revolution. That involves Bitcoin and to some extent Ether, which means and each one of these words is really important. First, global, private, digital, rules-based monetary system in history, right? That's a big idea. Then we have the financial services revolution, DeFi, decentralized finance, digital wallets. That is going to transform the financial services industry. And then the third thing the blockchain technologies are accommodating and creating is the metaverse, the next generation internet. And NFTs, we believe, and again, each of these words is very important, NFTs are evolving towards, not perfect yet, but the first global, that gives you an idea of the scope and scale of this idea. Global, private, digital, immutable, critical word there, property rights system. And if there's anything that brings countries out of poverty, it's personal property rights that are immutable. So I think many people are thinking about just games and so forth, but this is a much bigger idea than just games, skins in games. And we think it's going to impact every sector. What's the latest wrinkle in our thinking? Many people think that we're going to be a bunch of avatars running around talking to each other in the metaverse. And we are in Decentraland. We have something called the Sigmund Ark Gallery, if you want to go looking for it. And that's fun. And we all have our avatars and so forth. But I think Zoom has taught us that maybe it's not going to be avatars the the way we're seeing them now. Maybe they're going to be real lifelike faces attached to the avatars that are able to show expressions like you and I are showing expression. Yes. I think COVID and Zoom has even impacted the way NFTs are going to evolve in the future.
Right. So definitely something that we should keep an eye on, and you guys will be doing your level best to introduce them into the portfolio. So I think this is also a good juncture to just remind everyone that, because we're talking about disruptive innovation, at some point in time, the stuff that we're looking at today could eventually also become a bit of an old tech. So that's got to go out and all these new things got to come back in. Isn't that right?
Yes, and you'll notice in our flagship strategy that we don't own the FANGs. And many people were saying, and what's so interesting about the broad-based benchmarks out there, S&P, NASDAQ 100, they own the FANGs and they're in the top 10. So we're a good diversifier from that point of view, but even the disruptors can be disrupted pretty quickly. Take Facebook. All of us have watched TikTok, but no one really understood until they reported their last quarter how disruptive TikTok is becoming. And even Facebook, they thought they would be able to pull another stories in Instagram and knock off TikTok, just like they have done a good job of emulating Snapchat, right?
Yes.
But this is not their DNA. Their DNA is all about me, a person. Look how great my life is on Instagram and so forth. Whereas TikTok's DNA is all about entertaining. It's all about you. We want to make you happy. And it's the short form video, which is getting longer. Yes, disruptive innovation can even disrupt the disruptors much more quickly than anyone possibly could have imagined.
Yeah. So in other words, we should put on a slightly different lens, right? Because as perhaps the more older audience, the mature audience, we kind of think, oh, this is a fad, but it could be something that's actually a form of a disruption, right? Cathie, I wanted to just dwell on this other point before we go into the last leg of some of the questions, and that is, obviously, everyone down here, we've talked a little bit about the factors that cause, the fund to drop and the stocks and shares to get beaten up quite badly and all that. And one common question is, when are we going to see some kind of recovery? Now, obviously, from my innocent perspective, if Russian-Ukraine war is over tomorrow and supply chains and all that are all done, obviously things will revert back to normal. But it isn't so easy from the life of a fund manager, I would suppose. So perhaps maybe to answer this question or to give some insight to our audience tonight about how the portfolio will rebound, could you think of maybe 2 or 3 examples in your portfolio that you feel they are severely beaten down? And I believe in some of your videos on commentaries, the word you use is deep value, right? Some of all this stuff that's what you think is deep value and no one appreciates. And all we have to do is see 2 or 3 of these things, turn the corner, and we will see, a change in fortunes in terms of the fund, NAV, and performance. Yeah.
Sure. So if we go back to February of last year when the strategy peaked, at that point, according to our estimates, which are both top-down and bottom-up estimates, at that point, even at the highs, we thought that the portfolio, the flagship strategy, was going to deliver a compound annualized return of 15%. Pretty good. That's about nearly twice the stock market average over history. Today, that number is north of 50%. Now, we can be wrong, but we can't be that wrong. Maybe, we can't be that wrong because Wright's Law works. Wright's Law really works. I think the portfolio will start to outperform when it becomes clear that the global economy is laboring and starting to slow down. We think Europe could be in a recession. Because of the energy crunch and because the war is right at its borders, right? And we know that China has been dialing down growth. In fact, there are some estimates that its growth rate, I've just been watching Alibaba and Tencent, their growth rates have dropped dramatically down into single digit. Haven't seen these growth rates for years. And these were very rapidly growing companies. And so we think China is also slowing down, and which will have an impact on the rest of Asia and even Latin America. So the question is about the US. And as I mentioned, the consumer is also already showing signs of being worn out. And the yield curve is telling us that growth is going to disappoint. When growth in the economy disappoints and inflation starts coming down, and we're already seeing signs that inflation is beginning to top out. You saw average hourly earnings flat. Expectation was 0.5. This was in the U.S. economy. You saw core PPI increase much lower than expected at 0.2. You've seen oil prices top out maybe at 130. They're closer to 110, 115 now. So we're beginning to see at the margin what the bond market is in effect signaling, which is slower growth, lower inflation. And I believe that our growth rates, if you look at our growth rates, and we've done comparisons to tech and telecom bubble, our growth rates are much higher than even during the bubble times. Our profitability, just using consensus estimates going out 3 years, if you look at enterprise value to gross profit expectations, the profitability based on consensus expectations, not ours, and our expectations, our profitability is 3 to 5 times that we saw in the bubble and in the bust. We don't believe that our companies are going bust. We have been waiting for these platforms to gain traction and grow exponentially for 20 to 25 years. It's happening now. And when the growth rates relative of our portfolio companies relative to the economy start shining, and we think it's happening now. And when we get past the toughest comparisons, especially for the stay-at-home stocks, the Teladocs and the Zooms, many people say, oh, that was just because of COVID. It's not. It's not. And a great example is Zoom. This is the first rip and replace cycle in capital spending for enterprise communications since the early 90s. Now, enterprise communications is a $1.5 trillion category. And Zoom's revenues is $4 billion. We think Zoom and Microsoft, that they will carve up this market and take it away from the Ciscos and Polycoms of the world. Right. So very big idea.
Right. Thanks so much, Cathie. Now, obviously, like I said at the beginning, we are all invested, yourself, myself, we're all invested into the funds. So we are also sharing the investors' pain, on the slide downwards. And so we're not taking any of all these lightly. But perhaps just to help the rest of the audience here, and I'm going to take a stance of a bit of the devil's advocate right now, and say, what if we are wrong, right? And I think the key question is not that everyone doubts Ark's research and all that, but because as well, there's all these guys that are, anti-Ark out there in the marketplace, and they're shorting whatever you're buying, for example, and they're buying whatever you guys are shorting. So what do you make of this particular situation? I think I'm getting a lot of questions from many of the audience members out here, and they would love to hear your thoughts really about, the competitor space out there as well.
Yes, well, it almost proves the point that I made earlier, which is investors were competing against each other in the 90s for more technology. Technology got up to nearly 40% in the average portfolio, in the flagships portfolios out there. And that was wrong. That was wrong, right? Now you've got investors, as you say, they're shorting innovation. Think about that. They're shorting the way the world's changing. And the way the world's changing is not going to stop. So if we are right, and we're not always right, just to make sure everybody understands What we do during a risk-off period, and this one's been awfully long, I've never seen a longer one. What we do is we concentrate our portfolios towards our highest conviction names. So we, in the flagship portfolio, have gone from 57 names down to 35 names. Think about that. What we're really doing there is saying we're lowering the risks. Which companies are we maybe not so sure are going to be the leaders as these forms of innovation take off. So we concentrate towards our highest conviction names, which is another way of saying we think we can be wrong, and we've done something about it. So we feel our conviction and the scoring system that we use in our portfolio tracker has, because of the concentration, our scores have gone up, which means our conviction in the names that are remaining have actually gone up.
Right. Cathie, can I just interject so that I can get this point very clear as well to the audience out there? Because obviously some people's criticism about us shrinking our number of stocks within the portfolio is, Nickel EM, Ark, they've just lost it. They need to double down now on the mistakes that they have made. And so that's why they're doing that. So we're just trying to be really clear here for the benefit of all the audience. That's not what we're doing, right?
Actually, from our point of view, and I've done this in every correction of my career, and it usually works out. We've de-risked the portfolio by selling the names that at the margin we did not have as much confidence in as we do in our in the top 35 names now. So absolutely it is. And the reason we have this opportunity to concentrate is, which is, by the way, introduces tax efficiency into the portfolio. We're selling stocks that have losses, and we're buying stocks also that have losses. So these losses in the future can be taken against future gains. So while that's not an explicit, we don't say we are tax efficient, because of the way we do concentrate during risk-off periods, we tend to introduce tax efficiency over time.
Right. Thanks so much for that, Cathie. I think that's a very encouraging note to end off this particular portion. Yeah.
Just one last thing. If we are right, now the strategies that exist just to short Ark, they do no research. They do no research. And if so, what they're essentially saying is our research is wrong. We think our research is right. If we are right, they will have to cover their shorts, which means that the recovery, when it finally takes place, is going to be powerful.
Yes, and they'll be buying from you probably because they have to cover their shorts.
That is right.
Right. And thank you so much. And I mean, personally, anecdotally, I always make a joke sort of about all these short people, because like what you say, they don't do homework. They're essentially taking the easy way out. Cathie says A, I'm going to say B. Cathie says B, I'm going to take A. And they run a YouTube video for 10 minutes and they make $1 million out of it. But they don't do any homework whatsoever. Yeah.
This is also the flip side of what we experienced early last year. We could do nothing wrong. And I said at the time, hold some powder dry, some powder dry. When you get into the psychology that a portfolio, a strategy can do no wrong, it's usually time to take some profits. When you get into a period where people are saying, oh, they can't do anything right, that's usually a great time to buy.
Yeah. Right. And I think just before you logged in, that's exactly what, Aimee from Affin Hwang was showcasing, a quote from Warren Buffett: be greedy when everyone is, fearful, and be fearful when everyone is greedy. So just on a rounding statement, I mean, I don't think the audience is going to hold you to that. So earlier on, when we led into this last final portion of this segment, we talk obviously about your number 15% CAGR, right? Year on year and all that. So given the pullback and all that, I mean, are we still thinking 15%? So clients will need to wait 3 to 5 years to see the doubling of the fund before they break even, essentially? Or do you think that number, essentially pushes up towards 20, 30%, and so on and so forth?
Yeah, as I mentioned, our research suggests, again, we could be wrong, but our research, and we come at research from the top down, from the bottom up, and we have a scoring system overlay. So we've got 3 checks and balances here. Our research suggests that the compound annual rate of return over the next 5 years will be north of 50%. Now, is that a promise? Of course, we can't promise that. But our research is very objective, and Wright's law is very objective. So we mentioned earlier, do the supply chain shortages slow things up in the short term? That's what's happened, perhaps. But the workarounds, which are all about innovation as well, innovation solves problems, right? Are part of our strategy. And so we think that the combination of Wright's law focused on the 14 different technologies in the portfolio and the workarounds that innovation will allow us to get around these supply chain shortages, we think that the number is, I'll just say, well north of 30%. Allow for mistakes, well north of 30%.
Right. Thanks so much, Cathie. I think that's very, very insightful in terms of giving us that expectation of what we should see in the portfolio. Just one last final question, because we're into our final last minute or 2 minutes. Obviously, like you said, we're not guaranteeing anything. There could be room for error and all. What are your steps that you are, finally just comment your steps in terms of where we are right now, going forward, maybe in the next 3 months, in the next 6 months, if things really, touch wood, I'm touching everything that I can. If things go down another 10, another 20%, what are the things that, the Ark team is really doing from a strategy perspective to shore up the portfolio? Yeah.
Yes. So, of course, if you said next 2 to 3 months, we'll have an earnings season where we'll get a lot more information. And if it turns out, let's just say we were to go down again, we will get information that will increase or decrease our confidence in one company versus another in the portfolio. And so we would, now, to be honest, the lowest we typically go is low 30s in terms of number of names. We're almost there, but we would continue that concentration. Okay, we have some information which tells us, our assumption about this company being the top company in this new innovation wave, it has gone down. And it could be something like management changes. When there are big management changes, there are 2 reasons for a management change. Either the strategy is not working, they're not executing correctly, or the company is moving from a startup into a scaling company. The latter one is good. The former one is bad. So we pay a lot of attention to management changes for clues. Are they executing properly? And is their technology playing out the way we thought it was going to play out?
Right. So, Cathie, in just one last rounding question, because I see this popping up in the Q&A, the chat box a lot. And I think a lot of people wanted to ask about why do we sell out of this name? Why do we sell out of that name? And if we go through each and every one, I think it'll be tomorrow before we end this seminar. But then can I just borrow that last sentence that you just said, because we're condensing that portfolio, these guys sort of like are out of favor right now because of the ranking system and all, but they're not out of your radar, right? Which means once earnings seasons and all that come in, if they represent good opportunities as well, bam, they come back into the portfolio, right?
Yes. Now, and just to give you a sense, during bull markets, how did we get to 57 names at the peak in February? From low 30s during the middle of COVID. We diversified the portfolio, put in even more liquid names. We call them cash-like names, maybe the Googles or large biotech names. They're more cash-like, and we'd be able to sell them quickly if we want to take advantage and concentrate the portfolio during the next risk off, which I hope isn't for 5 years.
Yes, thank you so much for that. So I hope hope, ladies and gentlemen, hearing from Cathie tonight gives you some kind of a reassurance as well that, she and the team are very much on top of things. Now, I know, you all have tons of questions, and we've really tried our level best to condense everything together into a very concise conversation for you. Cathie, thank you so much for your time. I'd just like to invite Aimee back onto the screen so that she can, give the final comments as well as, the close of the session. But ladies and gentlemen, before I hand back to Aimee, can you please join me in the virtual round of applause for Cathie as well? Those on Facebook, those on YouTube, if you can as well. Thank you so much, Cathie.
Thank you so much. Thank you so much, Darius, Cathie, for those insights and perspective right from the heart where disruptive innovation is happening from New York City. We really hope to catch you in Malaysia once travel borders are less restrictive. Yeah, Malaysia welcomes you with open arms. We can do an event with you here. Yeah.
We would love that. Thank you, Aimee.
Yes. Cathie, maybe a last word of advice for investors. Some investors have lost about 40, 50%. What's your advice for them? Personal advice, yep.
I can only give advice that I take myself, and you see us doing this in the portfolio. I have found over the years that averaging down into a move like this, you'd be surprised at how quickly you get your average back if you're consistent and average down. Again, we can't promise, but it has served my portfolio team and me personally well to average down. And again, when this, as Darius said, as Warren Buffett said, you buy when there's fear and you sell when there's greed. It does tend to work in this strategy.
Thank you so much, Cathie. And with that, thank you once again, Cathie and Darius. Lastly, we'd like to make a disclaimer to all our guests. Please note that today's forum and all related content is for discussion purposes only. Nothing from this forum is intended to be or should be construed as an offer to buy or sell or an invitation to subscribe to any securities or investments. Please do your own research and speak to a qualified investment professional before making any decision to invest. And with that, we hope this evening's session had been helpful. Do provide to us your feedback. And if you want more sessions like this, do reach out to our sales representative. Thank you all and have a great evening. Thank you.
Thanks, Aimee. Thanks, Cathie.